One of the reasons why the vast majority of the markets expect interest rates to go down by a lot and then stay there a lot longer is the lurking prospect for credit losses. And when you say the term credit losses, most people think you mean banks and bank crisis and something like that. But we're talking instead about shadow banks, the same types of investment funds and shadow vehicles that made themselves known only too well back in April. As it turns out, there may be a hidden problem of credit losses down in the shadows. The reason we call them shadow banks is because they mimic the activity of banks but aren't funded by depositors. They get equity from rich guys and institutions, then leverage the hell out of that equity via short-term funding like repo and other wholesale. Then these investment vehicles take those proceeds from all of that and relend into areas of the global economy the 20-year-long retreat in regulated banking has left completely underserved, to put it mildly. But since shadow banks have no depositors, they're not treated as banks, and because a good number of them are located purposefully offshore, these things are pretty deep into the financial shadows. And one aspect to being in the dark like that is the leeway they get in reporting and even determining credit losses. Now, that didn't seem to matter a couple years ago or even last year, but suddenly around April, as the US labor market is showing signs of visiting the wrong part of the beverage curve, suddenly the financial system is willing to scrutinize the activities of shadow banks for, as it turns out, very good reason. Now, we've covered shadow banks before several times, including warning about them from a few weeks before the April blow-up. All you really have to know and understand is that the regulated banking sector never recovered from 2008. It was an exact parallel to banks which went through the deflationary crash in the early 1930s. The Fed said it got everything right, but the banking sector showed instead it got everything wrong. And it was none other than Ben Bernanke who pointed this out in 1983, but then Ben Bernanke turned around in 2008 and did exactly the same things the Fed did at the start of the Great Depression. As a result, here in the 21st century, the banking system has not been the same despite popular imagination about what government bailouts actually accomplished. Those bailouts might have saved bank management and bank stocks, but the banks themselves were permanently screwed, and so was the economy. This is where the silent depression comes from. And with a broken banking system, that has meant, just like during the 1930s and the Great Depression, those banks only wanted safety and liquidity. So banks piled on government bonds and high-grade corporates. Anything perceived as illiquid was totally avoided. So no lending to small and medium businesses, and a catastrophic moratorium on mortgage financing to most individual borrowers. You wonder why there aren't enough houses in this country? This is the answer. Ben Bernanke failed, and the housing stock has been one huge sore spot of a collateral damage, pun very much intended there. But that systemic retreat of regulated banks left a huge opportunity for anyone who was willing and more so able to fill it. And that's where these investment vehicles came from. They are essentially blank balance sheets that are able to hold assets in a way that regulated banks aren't going to be able to do, with all of their scars and past baggage of that 2008 not financial crisis. And the non-bank investment funds began to explore that opportunity, those vast opportunities, during the 2010s. But the key for them is always leverage. So short-term funding is absolutely critical. The point, however, is similar to the role that banks serve, with one crucial exception. And one of the primary functions of the banking system is to redistribute money throughout the world, because we're talking about the Eurodollar system, which means global reserve money, ledger money, not government money. Now, some banks create the ledger money, and then others, mainly dealers, are central in recirculating it, keeping it flowing. That's the elasticity. Since ledger money is created by lending, that means someone has to be on the hook for the loans. And since 2007, the banks don't want to be on the hook, so they don't want to do it. And shadow banks have stepped up as basically clean balance sheets that don't have all of those legacy issues. Therefore, they can offer significant space to hold loans as money does get circulated, at least in diminished capacity overall. And their fee for taking the risk to redistribute money throughout the commercial and financial system is the returns that they generate. What is a Eurodollar University membership? It's where understanding the monetary world isn't a mystery, it's a method. If you're serious about your financial education and you want clarity in a world of volatility and misunderstanding, this is for you. Mainstream education has left so many gaps on the most foundational concepts, making sense of everything is practically impossible otherwise. With our memberships, we'll fill in everything that you've been missing. Whether you're starting out or sharpening your edge, our memberships scale with your goals. At Eurodollar University, we teach you about how money really works so that you can evaluate fundamentals and make grounded decisions. With a Eurodollar University membership, you get a comprehensive library of foundational and advanced lectures, in-depth case studies and real-world analyses, live Q&A sessions, regular updates on macro trends and even some central bank policies. And most important, how to interpret critical derivative market signals you will not find anywhere else. You can't be in position to succeed if you don't know how it all really works and fits together. So if you're ready to explore, master monetary systems, both past and future, with structure, clarity, and confidence, click the link in the description to visit eurodollar.university/memberships to join us today. But it was here in the 2020s where things really took off, and it took off for the same reasons that we saw the commercial real estate bubble. A whole host of bad assumptions about economic considerations back in 2021 and 2022. The idea of a recovery that was instead just a price illusion. Like a lot of everyone else, shadow bankers thought the government had done a fantastic job engineering not just a hot recovery from the lockdowns, but a red-hot one that would easily be sustained long into the future. And even after all that began to fall apart in 2022 with the arrival of Forgot How to Grow, which actually illuminated the so-called recovery and how it was only a price illusion, shadow banks, like a lot of others in the financial system, they just shrugged it all off. Jay Powell kept saying the economy was strong and very resilient, and admittedly, it did seem to be, especially in the United States when compared to many other places around the world, which fell into outright recession almost straight away back in 2022. The Forgot How to Grow experience in the US was far less visible, and because the numbers seemed to look good and the labor market was avoiding widespread job losses at the very least, shadow banks plowed ahead and the markets were only too willing to participate, including banks. In many ways, it was just classic reach for yield, the same types of ideas, the rationalizations that go into it, even if in this case, the yields that were being reached for did seem to justify any rationalization or any taken on risk that came up. The relevant comparison is when any financial system is reaching for yield as a systemic matter, it often does so overlooking rising risks and rationalizing them away while picking up that additional return. And again, over the last few years, this has been very easy to do given how the economy may not have looked right and felt right, but it definitely didn't look like it was fast approaching a major cliff. So it was more the proverbial boiling frog, which simply made it too easy to chase returns while taking in the soothing, solid words from Mr. Powell and his like, including the entire mainstream media. But we have to keep in mind that shadow banks and their private credit have largely been serving the underserved areas of the lending markets, the parts where the regulated banking system retreated from many, many years ago, which is a kinder way of saying riskier. That was the entire reason that regulated banks left them underserved in the first place. So quite naturally, these borrowers are going to be more susceptible to an economic downturn. The idea was it was too easy to ignore up until around, say, last summer, when suddenly the job market, which everyone thought had been bulletproof, suddenly showed up with holes all over the place. For shadow banking, though, it all came to a head in the chaos and disorder of late March and early April. Lost amidst the tariff focus and everyone being confused by the basis trade blowup, shadow banks were right at the forefront of the deflation. After all, the basis trade crackup was itself a product of repo market problems, the same wholesale pathology shared by shadow banks. And the data that we have, which I've gone over before, that comes from the Treasury Department, the tick statistics, they showed a massive and sustained, and that's the key part here, it didn't just end in April, but a massive and sustained rise in U.S. regulated banks, mainly dealer banks, redirecting funds in repo to offshore shadow banks who are not posting Treasury bill collateral to secure what were clearly emergency funds. In other words, shadow banks were on the edge of experiencing a full-blown liquidity crisis. And why? Because the system set aside reach for yield and rationalization and started to look at what was really happening inside these shadows. And it wasn't tariffs. It was the growing worry about what would happen to the credit portfolios of all these investment funds if the US economy did actually hit a major downturn. Again, before then, everybody thought that was impossible. The narrative of a solid labor market, a steady economy meant there was no need to be concerned despite rising delinquency rates all across the regulated system that we've also talked about before. Besides, as I mentioned at the start, shadow banks don't report or even classify loans and delinquencies in the same way as banks do. So when everything seems solid and resilient, even as delinquencies might be rising and piling up in reach for yield mentality, everyone's going to overlook shadow banks because they're not reporting higher delinquencies, so it appears to confirm the bias toward the economic narrative that's being spun by Powell in the mainstream. But then you get to April, suddenly everyone is taking the downturn in the economy seriously for maybe the first time in years. And the opacity of shadow firms worked against them in exactly the same way we saw back in the 2008 crisis. Now, I'm not saying the two episodes are comparable, only that one aspect of 2008, which made it so easy to spread the contagion everywhere, was the information asymmetry. Back then, no one knew what anyone had, so as things got ugly, the system rejected basically everyone because there was no way to tell who was going to get stuck holding what. So if you think shadow banks might not be giving you all the information about their credit quality, as wholesale funding providers, maybe they started to get cold feet. And that chilly podiatry was heavy among regulated banks too, because those regulated banks are heavily exposed to shadow banks, as we've also been talking about, by lending them a ton of money and backing their activities all across the shadowy credit world. So the possibility of a serious downturn, which the system confronted for the first time in April, triggered a backlash against shadow banks because nobody really knows what's really happening in their portfolios. They're not going to tell us, and when people do go looking for some answers, they don't really like what they're finding. So while the stock market and certain corners of riskier retail credit assets, they took everything in April to mean an overreaction to tariffs and nothing to be concerned about moving forward. The economy's just fine. That's not how the vast majority of real financial markets took the events in April and its aftermath, its longing and elongating aftermath. Equities are ignoring the piling up of proof the U.S. economy is actually sinking into deeper trouble as the jobs market already has reversed. It really is moving to the flat part of the beverage curve. But as it does, all those fears from April, they not only come back, they start to be more tangible and immediate than the tariff overreactions back then. And so the worse the economy gets, the greater the reason to scrutinize these shadows. But that's really hard to do. Shadow banks don't have to tell the public really anything. Plus, as I said at the start, they have wide latitude in a lot of credit arrangements to modify loan terms so as to avoid having to say a loan isn't performing or, worst of all, has actually in reality become non-accrual. These are called selective defaults. And among them are modifications like something called payment in kind, or PIK. This is where a borrower might be falling behind on interest and principal payments, yet the shadow bank lender says, no big deal, just pay all the interest and principal you owe at maturity. So there's a big payment awaiting for a borrower that's already in big trouble, yet the loan carries on like nothing has changed when something big absolutely has. Like I said, there isn't a whole lot of data out there, but there are some tantalizing nuggets that we can depend upon and draw upon to start to fill out a bigger picture of what might be happening, even though we can't see it directly. And one of those came from Standard & Poor's last month, which put out a report that was simply titled Private Credit, the Rising Defaults. And we talk about private credit, we're also talking about what shadow banks are offering. And it detailed and gave us more estimates about these selective defaults and how it seemed that many of them were being used purposefully just to avoid having to make any disclosures. Quoting the report here, more than a third of borrowers from S&P Global Ratings credit estimate pool that were subject to actively tested leverage-based maintenance covenants appear to have loose thresholds with current headroom above 40%, and even higher proportions in the core and upper segments of the middle market. These large cushions reflect covenants that were set very wide to closing levels as opposed to signaling meaningful deleveraging. These generous covenants are leading to a rising trend in selective defaults, which, again, quoting S&P here, is quite concerning. And S&P goes on to note, quote, the study highlights an alarming surge in selective defaults, which outpaced conventional defaults by a 5-to-1 ratio in 2024, just 2024, driven by flexible covenants and payment-in-kind conversions. In other words, there is a lot of modification going on in what appears to be another dose of shadowy extend and pretend. And it wasn't just S&P. We've got, as I said, a couple of other sources, and I'll give you a couple examples here. Valuation firm Lincoln International, also from last month, it wrote, quote, as a result, the use of PIK, that's payment in kind interest, may be a better indicator of stress. Lincoln saw that PIK interest is present in 11% of all deals it values, 11%. And of those deals, 53% had bad PIK. An example, PIK was not elected or available at close, but is now being utilized. This translates to a shadow default rate of 6%, which may be more indicative of the health of private credit down in the shadows. This rate is further corroborated by the fact that the average loan to value for companies with bad PIK was 45% at inception compared to an average of 83% today, a very, very clear sign of stress. This current, and they're using their term here, shadow default rate of 6% compares to just 2% back in 2021. So right there you can see the forgot how to grow economy that is now being covered up by extend and pretend latitude among shadow bankers. And here's another source, one that was reported by Bloomberg also in August, late in August, which also found pretty similar shadow default rate numbers. Going to the article there, quote, warnings on defaults are starting to pile up in the 1.7 trillion private credit market. It's probably bigger than that, prompting at least some analysts to raise concern about unappreciated risk in one of Wall Street's favorite money spinners. While there is no universal definition of what constitutes default, and that's the problem in private credit, default rates for the market are currently in the 2 to 3% range, but if so-called non-accrual loans, those on which lenders expect to book losses, if they're added to the mix, that rate climbs to 5.4%, according to a JP Morgan Chase report that's based on data from KBRA DLD. So what does all of that say? It says that in all likelihood, there is indeed a hidden credit problem out there in the shadows, and then more likely that hidden credit problem started to get exposed, or at least to be scrutinized in April among liquidity providers. And that's the real downside danger here. That when you have a credit problem, it starts to spill over into the monetary system, becomes a money problem, goes well beyond where the credit problem originates. But let's be perfectly clear here. These estimates are far from catastrophic. We are not talking about a replay of 2008, but that's not really the full extent of the danger. First of all, they put them in line with where other risky forms of credit like leveraged loans and corporate finances currently sit. However, the reason why there appeared to be such a harsh reaction in April across liquidity markets was everyone began to do some future math, extrapolating forward into what may be a major downturn that suddenly didn't just seem possible, it appeared increasingly likely. And as we go forward in the summertime, that likelihood only goes up, even if it's being ignored in places like the stock market. Even Jay Powell is starting to admit it, which is why they're cutting interest rates at the Fed. Because if there is a 5 to 6% effective default rate among shadow banks right now in private credit, what might the default rate be, or even get to be, when unemployment rises maybe just a few official percentage points, and other businesses that are just trying to stay in business in this kind of environment with falling revenue and sharply higher costs, where does that put them? This is why more are worried today about what all this could look like tomorrow, knowing the chances that Jay Powell was right about the economy are dwindling with each successive rate cut. Powell himself was already forced to admit he was wrong about the solid labor market. How much will it take to get him to admit that he's wrong about everything else beside it, especially the bigger picture future implications? And the bigger implication that's lurking here in this credit problem, this hidden credit problem in the shadows, one is that we don't really have a good enough idea as to how big it is and how big it might actually become. On its own, that means a potential credit crunch into a broad economic downturn, which would amplify that downturn. That's not good, and it makes the contraction in the economy and labor market even harsher than it otherwise would have been. But the greater concern, as I just mentioned, is liquidity, potential for liquidity and spillover beyond the shadows. And this is also where the lack of information really drives that home. The comparison I mentioned before about with 2008 in information asymmetry. The credit problem risks becoming a money problem and even a systemic money problem, not just because of that asymmetry, but also from how exposed regulated banks are to all this, and that becomes the real systemic contagion. Not that we're talking about a repeat of 2008 again, but a potential serious setback in monetary and collateral flow that risks becoming a far greater than typical recession and volatility across monetary system, even if large banks aren't failing or in danger of failing at any point in between. Now, the failures of these shadow banks would be more than enough to put out some nasty consequences, and the failure of those shadow banks becomes a more likely possibility if all of these dominoes fall in exactly the wrong way, starting with the macroeconomic situation. That's because all of the ingredients are there, plus we've already seen once this year what happens when they do get mixed up and cooked up in the wrong way. So what all this means for right now is that it argues for further scrutiny and close vigilance about what's happening in these shadows. While we don't know for sure, we need to keep a very close eye on it because, as I just said, there's a lot going on there and a lot that is demanding our attention and continued focus moving forward, especially as the labor market continues to deteriorate, moving further down to the flat part of the beverage curve and raising the risks that what we don't see today becomes an even bigger problem tomorrow. The details behind the liquidity and monetary aspects to the shadow bank reversal in April, I went over all that in a video from a couple months ago back in June, and that's the one I've got linked below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.